quickly go across to the Wipro con call that's happening right now, Wipro management right now. Let's quickly go across and cut into the Wipro management talking.
Of our sectoral performance, the demand environment for sure, and the directions for the coming quarter. Q2 was yet another quarter of strong deal bookings. In total contract value terms, we closed large deals to the tune of $1.3 billion. This is the highest in the last 9 quarters. And this represents a 79% year-on-year growth and a 6% growth on a quarter-on-quarter basis. We booked as many as 14 deals in the greater than $30 million TCV range, versus 10 in the previous quarter. Total bookings from a TCV standpoint stand at $3.8 billion, which is a growth of 6% year-on-year. We added 1 new account in the greater than $100 million client category in Q2. We now have 22 accounts in that bucket. If you remember, we had 11 $100 million accounts in FY21. So we've doubled the number of accounts in the $100 million category. We have also won 2 close to $500 million deals in 2 of our large accounts. As has been the case for several quarters now, cash flow also has remained strong, but 145% of net income in Q2. EBIT, or earnings before tax and interest, of our IT services segment has increased 6% year-on-year. So it gives us great confidence that we are winning in the market against the backdrop of economic weakness. The business environment, as you all know, has been uncertain. Inflation has stayed high, as have interest rates. Clients are continuing to take a much more rigorous look at their investments. That is clear. They are hyper-focused on efficiency, on optimization of existing investments, and faster return on new ones. So, lower discretionary spending is a reality today. Conversion of order book has become slower. Transformation programs that are nearing their project terms are being replaced by new ones, but at a slower pace. All of this has impacted our top-line growth as well. In Q2, revenue declined 2% quarter-on-quarter in constant currency terms. But even though there's some softness in top-line growth, we are continuing to hold margins steady. Operating margin for the first half of fiscal year 24 was 16.1%. This is 110 basis points higher than our operating margin in the first half of fiscal year 23. Now let's look at our strategic market unit, our 4 strategic market units. In our Americas 1 market unit, revenues grew 1% quarter-on-quarter in constant currency terms in Q2. This revenue growth was led by strong performance in our healthcare business, as well as in the technology, the products and platforms business. Order bookings, in terms of total contract value terms, grew 36% year-on-year. Our Americas 2 market has higher exposure to consulting clients, as you know, and to the BFSI sector. So we saw a higher than usual impact of the macroeconomic slowdown. Revenues in our Americas 2 market declined 2.3% quarter-on-quarter in Q2. Europe has been a growth engine for the last 2 years, you know that, growing by 39% in FY22 and 12% in FY23. But slowing demand and reprioritization of client spends has weighed on our European business. As a result, revenues in this market declined 5% quarter on quarter. But we are seeing strong traction on the order booking side, which in total contract value terms increased 10% in Q2 year on year. So given our strong bookings in this market, we are confident of a swift rebound. Finally, in our APMEA market, revenues for the quarter declined 0.5% quarter over quarter. Our goal in this region is to capture the rapidly digitizing market. We are leveraging our global scale and domain expertise to continue to move our portfolio towards higher value transformation projects. This focus on improving the quality of revenue is now clearly reflecting in our margin performance, which has improved 330 basis points over the last 5 quarters. Being able to sustain margins despite softer revenues is largely due to our ongoing transformation efforts. This includes several programs around delivery excellence and operational efficiencies. Across the board, we are pivoting our business towards high quality, high potential businesses and reducing our loss-making accounts. We are working on faster bench deployment. In the last quarter, utilization increased to 84.5%, an improvement of 80 basis points quarter over quarter. Our account segmentation strategy, together with a one Wipro approach, is definitely helping us seal bigger deals with existing clients and win in a consolidating market. And I am proud that we are seeing these benefits within 3 months of moving to the new 4 global business line operating model. Amit will share more details shortly. Both on the delivery assurance and efficiency side, these actions are having an immediate positive impact, while also setting us up for long-term margin resilience. Because profitable and sustainable growth is our top priority. In Europe, we closed 3 large consolidation deals in Q2 at a 100% bid to win rate. Example, a global bank has selected Wipro as its partner to deliver multi-year digital transformation initiatives.